All right, everyone. So today we're breaking down how to tell when the market is actually worth trading and when it's better to sit on your hands. I'm going to walk you through the key conditions that separate high probability setups from low probability traps. So without wasting more time, let's begin. Okay, so the difference between consistent profitability and frequent losses in day trading often lies in recognizing when market conditions favor your strategy. Now, I think you all know by this point that not every day is a trading day. Sometimes not every week is a trading week. Some days you might not have anything. Some weeks there might be no trading days at all. You just have to be patient and know that by choosing not to trade, you are already distinguishing yourself from all the other traders. So please don't feel bad. I'm going to show you why it is that what you're actually doing is actually a good thing and how you can better recognize when to trade and when to not trade. All right. Okay, so let's start with identifying high probability market conditions. The first one being clear market structure. What you want to see is order, not chaos. Look for obvious trends. Higher highs and higher lows in uptrends, lower highs and lower lows in downtrends. Swing points should be clear. Price should respect your points of interest, like for value gaps, order blocks, etc. The odds are way higher that price will behave predictably if you see these things. Okay, so for example, like you see here, pretty nice breaks of structure, right? Some pretty obvious pullbacks that gets swept, right? Turns into liquidity. Price respects the order block down here and then goes back up to create more structure. Now, ladies and gents, I will show you some examples, obviously, of what good market conditions look like and what terrible market conditions look like. But typically something like this is something you would like to see. Just make sure that you are marking up your points of interest, you are marking up your breaks of structure. You will be surprised how much of a difference that makes. Alright, so next we have is strategic liquidity zones. So liquidity zones are where retail traders get trapped and institutions know it. You'll often see price sweep stops above highs or below lows and then sharply reverse. That's a liquidity grab. When you catch the reversal after the sweep, you're trading with smart money instead of against it. Now, there are some strong reactions after liquidity sweeps, signaling high probability reversal opportunities. So, ladies and gents, when you start seeing some consolidation, right, before you start looking for trades or even during your trading window, be very careful because that can be a signal of liquidity getting built so that way it can get swept up like we had right here, right? So, usually as well, after liquidity gets swept, sometimes price tends to consolidate and then move in its intended direction, or sometimes price will shoot up like it did here and then move in the direction it wants to go, right? So just be very, very careful. Also, make sure that when you're on higher time frames, make sure that price isn't approaching those higher time frame liquidity points, because once price sweeps those higher time frame liquidity areas, price can start consolidating and then you get caught in that consolidation when looking for trades on the lower time frame. Okay? All right, cool. All right, so now we have order flow analysis. Order flow tells you who's really in control, buyers or sellers. Clear momentum and strong directional pushes show intent. But if price is stuck between premium and discount arrays on higher time frames or even lower time frames, that's trapped order flow. Wait for a clean break and real displacement before getting involved. So here you'll have some sell side, some buy side, right? You want to see price making some breaks of structure, okay? Clear breaks of structures. You don't want to get stuck in some kind of consolidation. Price isn't respecting your points of interest. You want to be able to see some clear movement, okay? It's really that simple. I already made a video on how I select my pairs for trading. That is one of those things, right? I suggest you look at that video because it kind of goes together with this. All right, so definitely check that out. All right, so now we have to talk about fair value gaps. Now this is big. Fair value gaps are like footprints left behind by aggressive institutions. If clean fair value gaps form and hold, price has strong intent. If you don't see fair value gaps, or if fair value gaps keep getting erased quickly, it means consolidation. Low probability, stay patient. Now, here in this example, you can see that I have some bullish fair value gaps that did not hold, right? I have two right here. And then I also have some bearish fair value gaps that also marked up, but guess what? They didn't hold either. And here there was a moment where price didn't even show any fair value gaps, which means consolidation. So ladies and gents, be very careful. Keep an eye out on this before your trading window opens. Make sure that there isn't any consolidation or any disrespect of fair value gaps like this. Why? Because if fair value gaps weren't being respected in the previous trading session, they probably won't be respected in yours. Alright, so now let's talk about optimal trading sessions, the kill zones. So timing matters, and here are the best trading windows according to ICT, right? You have your London kill zone, you have New York kill zone, you have your macro time range. So this is when you trade more like through a very smaller session, but you're using minutes instead of hours to define your window trading range. Okay, I already made a video on this. You guys can check out my video on the myth of time trading or something like that. I can't remember, it's been a while, but I'll link it down in the description below for you guys. Point is that I love kill zones. Kill zones are actually great. This is one of the few things where I think ICT actually did a really good job in bringing light to. So if you don't trade in kill zones, or if you're someone that is thinking about trading kill zones with their trading strategy, I highly suggest you do it. Why? Because institutions really do flood the market with liquidity. So please definitely incorporate kill zones if you haven't. Alright, so now let's talk about recognizing low probability market conditions. And we're going to kick this off with holiday and low volume periods. Holidays, especially USD bank holidays, kill volatility, especially in Forex. Even if you find a technical setup, it's more likely to fail. Indices might still have some action, but Forex is usually dead. Better to just skip these days. And here guys, you'll usually notice that when trading with low volume, you'll notice that your points of interest either don't get reached or they just simply aren't respected. And so you have to be very careful when trading during holidays or even low volume periods. My personal recommendation is just simply not to trade them, and even if you do have trading bots, I would highly suggest you turn them off, just because it increases the probabilities of losing money on these specific days. Alright, so now let's talk about post-liquidity run environments. After big liquidity sweeps, the market often chops sideways. That edge you had before, gone. Forcing trades after liquidity runs is one of the fastest ways to bleed out your account. Why? What usually happens? Well, markets become choppy and indecisive after major liquidity pools have been targeted, specifically the liquidity pools on higher time frames. For instance, here you can see that I have my weekly lows, right? What happens after it gets swept? As soon as the weekly lows get swept on the 4-hour time frame, price starts becoming choppy, right? And then it finally starts shooting up. But what happens again? Price can become a little bit more choppy again, goes down, doesn't really have any direction, right? And you're waiting for price to finally give you something, but it's going to take a while. Now, it doesn't always happen, but it is something to keep an eye out on. I mentioned this earlier, but this is just a way better example of what it would look like. Okay, so be very careful, especially when approaching those weekly highs or lows. Alright, so now let's talk about indecisive price action real quick. Erratic moves, frequent fake outs, small wiki candles, these are all signs that nobody's really in control. When price doesn't respect levels or indicators, the probability drops fast. Step aside when you see indecisiveness. Now this can happen at any time, at any moment, at any day. Alright, just be very careful. As you can see in this example, I have an order block here, right? Price sort of choppy, barely any fair value gaps, taps into the order block, chops up a little bit more, disrespects the order block, and then starts moving down a little bit more, right? Be very careful during these times. Again, this can happen at any moment, at any time. So make sure you're keeping an eye out for this before your trading window opens up. All right, so let's talk about practical framework for assessment, aka a mini recap. So number one, evaluate market calendar and volume. Check holiday schedules, economic announcements, day of the week, and current volume compared to average. Now, real quick, I forgot to mention this. I know that people like Sir Pickle like to trade during red folder news, but he trades during specific red folder news, not just any type of red folder news. Now, me personally, I'm not a huge fan of trading during those moments, but since it does seem to work for a lot of people, I would highly suggest you look into it. I might make a video on this, I might not, but I do highly suggest that you look at his channel. I'll link it down in the description below. He does an amazing job explaining this. Step 2 is analyze recent price action. Examine if price has recently run major liquidity pools, completed significant moves, displayed one-sided momentum or choppy action, and respected or violated technical levels or your points of interest. Step 3 is identify key institutional levels, map out order blocks for value gaps, liquidity zones, and major support and resistance levels, or really just any other POI that you like to use. Monitor real-time market structure. Watch for market structure shifts, displacement, price behavior around key levels, and respect for technical patterns. That easy, that simple. Now, risk management adaptations. In high probability environments, employ standard position sizing. Consider multiple positions if diversified. Place stop losses at technical significant levels. Extend targets to capture larger moves. In other words, when conditions are good, use your normal position sizing, right? If you're risking 1%, just risk 1%. And let your trades breathe with some bigger targets. Now, in low probability environments, reduce position sizes by 50 to 75%. Consider sitting out until conditions improve. Tighten stop losses to minimize damage. Reduce profit targets to secure gains quickly. Focus only on the highest quality setups. In other words, cut the size. Instead of risking 1%, you might want to risk 0.5. Tighten your stop losses. Secure your profits quicker, or just sit it out all together. Okay, so I just want to show you a quick example of what good conditions look like before your trading session. So here, what can you see? I'm on Euro USD, and we can tell that it's pretty bearish, right? Now, if I were to draw up all the fair value gaps on here, you'd see that they'd most likely be respected. So it's clear condition. I can mark up my breaks of structure, right? Here's one right here, and then here would have been another one. And here is some liquidity that can be targeted, right? Now, what do we have over here? We have a order block here, or a supply zone, resting right above the Asia highs. So what does price do? I wait for my trading window, which is the kill zone. And this is actually part of my strategy that I already have a video on. It's part of my supply and demand series, so check that out. What did I wait? I wait for price to sweep up these Asia highs, tap into that order block, and then I entered here. Or you could have waited and looked for a rejection here and then gone for another little bit more of liquidity here, or you could have gone for just a strict 2R as well right here, and you still would have made some money at the end of the day, right? But it's very easy, guys. Just make sure you have some clear market structure. Make sure there's fair value gaps. Make sure it's not consolidating, right? And remember, just because there is a little bit of consolidation, that doesn't mean that there's not going to be a favorable trading window. Just make sure the entire sessions before it aren't consolidating. Make sure that you can see some clear structure. All right. Obviously, there can be a little bit more that goes along with it, but I'm just using this as an example of the advantages of identifying these things and not being scared of entering, even though there is a tiny bit of consolidation, because that tiny bit of consolidation can be used as liquidity. But again, I know I'm repeating myself. Make sure that the previous session wasn't consolidating as badly, or that make sure that you have clear market structure the previous days, or just overall, right? Overall, we have some pretty good market structure. Okay? All right, cool. All right, ladies and gents, so thank you so much for watching this video. I appreciate you guys taking the time to watch my videos. It means a lot to me. And if you haven't joined the Discord, join up. It's free. I don't charge a single dime. You can reach out to me there, and you can also reach out to me on all my other platforms. I have Twitter, my email, my Instagram. Reach out, guys. I'm always trying my best to respond to all of you, so please be patient with me. And obviously, before I go, I love leaving you guys with some wisdom. I know you've seen me use this one a lot, but it really does resonate with me and with what we do. So this is from Proverbs 13:11. Dishonest money dwindles away, but whoever gathers honestly increases it. With that being said, guys, I will see you on the next one. Stay tough, stay trading, and I'll talk to you soon. Peace.